Warren Buffett didn't become a legend by inventing a new technology or inheriting dynastic wealth. He became a legend by mastering a game everyone thinks they can play, but almost no one can win. He beat the stock market for 50 straight years. The question is how? How did a quiet kid from Nebraska become the most successful investor in modern history? To understand the man, you have to understand the world that made him. Omaha, Nebraska, 1930. The Great Depression is tightening its grip. The stock market had crashed just months earlier. Farms are collapsing. Money is vanishing from daily life. But in one corner of this city, a young boy's world still revolved around the financial markets. Warren Edward Buffett, the son of a local stockbroker named Howard. Howard was disciplined, conservative, and exceptionally competent. Even as the world crumbled, he kept his family afloat. And as the economy clawed its way back, Howard's career soared. So much so that in 1942, he won a congressional election as a Republican at a time when Franklin Roosevelt and the Democrats were untouchable. And just like that, the Buffetts moved from Omaha to Washington, D.C. For young Warren, the change was brutal. He was an outsider. He was alone. So he buried himself in the only two things that made sense: math problems and the investment books he pulled from his father's study. Those quiet, lonely hours in Washington weren't just a distraction. They were the foundation of a lifelong obsession. He wasn't just dreaming of getting rich. He was building a plan. He was so sure of this plan that he told his classmates he would be a millionaire by the time he was 30, and if he failed, he promised he'd jump off the tallest building he could find. The plan started immediately. In high school, he bought his first stocks, tiny positions, just to see how the market actually behaved. But that was only the beginning. He launched business after business. He bought 6 packs of Coca-Cola and sold them bottle by bottle at school for a profit. He delivered Washington Post newspapers before dawn. He filed his first tax return at age 14, meticulously including a $45 deduction for his bicycle and his watch. Then, he moved from simple hustles to his first real assets. With the money from his paper route, Warren bought used pinball machines. He placed them in local barber shops. Suddenly, he had machines that made money for him while he slept. A few years later, when his father lost his re-election campaign and the family moved back to Omaha, Warren sold the pinball business for over $1,000. He took that cash and immediately bought a 40-acre farm, which he rented out to a tenant farmer for income. This was Buffett before he was Buffett, a teenager experimenting with business models, cash flow, and the raw power of compounding, long before he could legally drink. But the real turning point, the moment that set the course for everything that followed, came after college. It came in the form of a rejection letter. Harvard Business School didn't want him. So instead, he enrolled at Columbia University in New York. And there, he walked into a classroom and met a professor who would define the rest of his life, a man named Benjamin Graham, the father of value investing. In 1949, a book called The Intelligent Investor landed with a quiet thunderclap. Its author, Benjamin Graham, laid out a philosophy that was simple but revolutionary. Find great companies selling for less than they're actually worth. Find a dollar that's trading for 50 cents. A young man from Omaha named Warren Buffett didn't just read the idea, he devoured it. Graham saw the raw talent and hired him. In Graham's firm, Warren learned to dissect businesses with surgical precision. He looked past the market noise, past the media hype, and went straight for the cold, hard numbers on the balance sheet. He learned to find what a company was truly worth. But just a few years later, Graham retired. Buffett was forced back to Omaha to strike out on his own. He wasn't starting from scratch. By then, he had saved $175,000, the equivalent of several million today. With it, he launched the now famous Buffett Partnerships. His strategy was pure Graham. He bought what he called cigar butts. These were dying companies, ones that maybe had one last puff of value left in them. But they were so incredibly cheap that even that single puff was profitable. One of his early masterpieces was the Sanborn Map Company. Sanborn once had a near monopoly providing detailed maps to insurance firms, but its main business was fading into irrelevance. The market saw a dying company. Buffett saw something else, something hidden in the numbers. For 20 years, Sanborn had been quietly taking its profits and investing them into a massive portfolio of stocks. That investment portfolio alone was worth $65 a share, but Sanborn's stock was trading for just $45. It was a dollar bill sitting there, priced at 70 cents. Buffett bought aggressively. He gained voting control, forced the company to liquidate that hidden portfolio, and handed his investors a 45% return in 2 years, with almost no risk. He repeated this formula again and again. By 1962, at just 32 years old, Warren Buffett was officially a millionaire, 2 years ahead of his own schedule. That very same year, he found his next cigar butt, a fading textile mill in New England called Berkshire Hathaway. Its business was on its last legs, but its assets, the physical buildings and machinery, were worth far more than its share price. Buffett bought in heavily. He expected a simple, polite buyout from the company's CEO. The CEO verbally agreed to buy Buffett's shares for $11.50. But when the official offer came in writing, the price was $11.37.50. That tiny 13-cent insult changed Buffett's life. He was so infuriated that he didn't just sell his shares. He started buying more and more. He bought out the entire company just so he could fire the man who tried to cheat him. And in that moment of anger, Warren Buffett accidentally acquired the corporate shell that would become the platform for one of the largest fortunes in human history. But owning Berkshire Hathaway also forced him to rethink everything. He was tired of one-puff companies. He didn't want mediocre businesses at cheap prices. He wanted wonderful companies at fair prices. His first major purchase under this new philosophy was American Express, a company he still owns today. But the true engine of Buffett's new empire, the thing that would power Berkshire Hathaway for decades to come, wasn't a stock at all. It was something far more powerful: insurance. To most people, insurance is boring. A necessary chore, a stack of papers you file away and hope you never have to look at again. But to a young Warren Buffett, it was something else entirely. It was the closest thing capitalism had to magic. He saw something that almost everyone else missed, a powerful secret hidden in plain sight. Here's how it works. Insurance companies collect massive amounts of cash, your premiums, long before they ever expect to pay it out. You pay your car insurance every year, but a claim for an accident? That's unpredictable. It might happen next month, next decade, or never. This creates a giant pool of capital that just sits there. Idle money. Buffett called it float, and he realized it behaved like a giant interest-free loan that he could invest however he wanted. Think about that. If you buy an insurance company, you're not just buying a business. You're essentially buying a cash-producing bank. A bank whose liabilities, the potential claims, can't be withdrawn on demand. There's no run on the bank. The money stays, and it works for you. So, in 1967, that's exactly what he did. Buffett bought a company called National Indemnity. It was the first pillar of what would become the empire of Berkshire Hathaway. Over the next 30 years, he kept adding more insurance firms to his collection, the biggest prize being Geico in 1996. With each acquisition, the float grew from millions to billions. And with billions of dollars at his disposal, money that wasn't his, but that he could use as if it were, Buffett could make enormous, concentrated bets. He wasn't just picking stocks anymore. He was buying huge pieces of the very best American companies: Coca-Cola, the Washington Post, American Express, Gillette, and much, much later, Apple. He was wielding a powerful form of leverage, but without any of the traditional risk of debt. If his investments went south, he didn't owe anyone. He just had less float to play with. The results were staggering. By 1983, Berkshire's investment portfolio crossed $1 billion. Just 3 years later, in 1986, Buffett himself became a billionaire. And from that point on, the engine of compounding never stopped. The snowball just kept rolling, getting bigger and faster down the hill. Now, it's easy to look at that success and think it was about genius stock picks or predicting the future. But Buffett succeeded because he mastered a simple 4-part philosophy. First, buy great companies, not speculative stocks, but durable businesses with strong brands. Second, pay a fair price. Don't overpay, no matter how good the company is. Third, use float as the fuel. That was his secret engine. And fourth, let compounding do the heavy lifting. Time is the most powerful force in investing. It sounds simple, but it's not easy. Because the hardest part of Buffett's entire playbook isn't the math or the strategy, it's the discipline, the sheer, unwavering patience. He never chased hot trends. He never rushed into a deal. He never, ever panicked when the market crashed. He simply waited, sometimes for years. He treated investing like a baseball player at the plate, waiting for the perfect pitch. And when the market finally served one up, a great company at a bargain price, he would swing and swing big. And that patience, that discipline, built an empire. Today, Berkshire Hathaway is one of the most powerful and respected conglomerates on earth. And Warren Buffett, the once lonely boy who stood in his father's study, dreaming of numbers and business, became the most beloved and trusted investor in modern history, all because he found the magic hidden inside the most boring business imaginable. Hey, if you enjoyed this video, don't forget to hit that like button and subscribe to The Business Lens. It really helps us keep creating stories like this one. And let us know in the comments what company, empire, or business figure you'd like us to cover next. We read every suggestion, and your idea might be the next deep dive on this channel. Thanks for watching, and we'll see you in the next one.